Make banks irrelevant. That was the mission. In 2008, a programmer published a 9-page document with only one goal. Build a currency that does not need banks. No middleman, no central banks, no Goldman Sachs. A digital rebellion against the entire financial system. Fast forward to today, the biggest Bitcoin fund in history, run by BlackRock. Goldman Sachs reports over $1 billion in Bitcoin ETF holdings. The European Central Bank just agreed to accept blockchain-based asset as collateral. The rebellion? They did not destroy the banks. The banks absorbed the rebellion. And that changes everything how about you should think about this asset. In the last episode, I showed you why gold is an insurance policy, not an investment. And I asked the question, is Bitcoin a complement to gold, a replacement, or something entirely different? Today, I'm answering that question. With hard data, no opinions. I will show you who is actually buying Bitcoin with real money, and why most headlines get this completely wrong. Why the digital gold narrative spectacularly failed in 2025. How global regulatory landscape is creating winners and losers among investors right now. And the exact allocation percentages that BlackRock, Fidelity, and ARK Investment recommend. Quick disclaimer, this is financial education, no investment advice. Let's get into it. So, who is actually buying? Let me clear up the biggest misconception in crypto media right now. Everyone says BlackRock is buying Bitcoin. They are not. BlackRock built the highway. Institutions and retail investors are driving on it. And BlackRock collects the toll. Their iShares Bitcoin Trust, IBIT, is an ETF. The roughly 760,000 Bitcoin held inside that fund belong to the people who bought shares, not to BlackRock. BlackRock earns a 0.5% annual fee. That is their business. Infrastructure, fees, scale. And here is what most people miss. Almost half of the demand for IBIT comes from regular retail investors. 75% of them had never owned an iShares product before. Bitcoin brought an entire new customer base to the world's largest asset manager. Now, the speed is remarkable. IBIT reached $80 billion in assets in just 374 days. The gold ETF, GLD, needed over 1,600 days for a similar milestone, roughly 5 times faster. But speed of product adoption is not the same as conviction, so who's actually putting real money on the line? Start with corporate treasury. MicroStrategy, now called Strategy, holds over 700,000 Bitcoin, purchased with their own balance sheet, financed through stock issuance and convertible bonds. That is real skin in the game. It's also real risk. They reported over $5 billion in unrealized losses during the recent correction. Tesla holds around 11,000 Bitcoin. They famously sold 75% in 2022, a decision most analysts now consider a mistake. On the institutional side, Harvard expanded its Bitcoin position by over 250%. The Wisconsin State Pension Fund allocated $160 million, and 14 US pension funds now hold some form of Bitcoin exposure. And 74% of family offices globally are exploring or actively investing in digital assets. But here's the number that keeps it honest. Global pension and sovereign wealth funds allocation to Bitcoin sits at roughly 0.03%. The smart money is arriving, but it's arriving with tiny positions and strict risk limits. Now, the other side. Vanguard only allowed Bitcoin ETF access on its platform in December 2025. After a customer boycott campaign, they still offer no own Bitcoin product. One of the senior leaders compared Bitcoin to a collectible toy. Warren Buffett has called Bitcoin red poison squared. Berkshire Hathaway has never invested and says it never will. The European Central Bank published a paper in 2024 stating that the fair value of Bitcoin is still zero. And this tension is what makes Bitcoin unique among asset classes. The world's largest asset manager is building infrastructure for it. The world's most famous investor says it's worthless. Both are smart. Both have reasons. Larry Fink's own journey tells that story perfectly. In 2017, he called Bitcoin an index of money laundering. By 2024, he called it digital gold. By late 2025, he called it an asset for fear. Something you own because you're worried about your financial security. That is not a man changing his mind randomly. That is a man watching institutional demand data change the equation. In the last video, I told you that gold is an insurance. It pays off when financial systems has its worst day. So, does Bitcoin do the same thing? The data from 2025 gives us a brutal answer. gold in 2025 plus 67%, Bitcoin in 2025 minus 6%. Same macro fears, same geopolitical tension, completely opposite reaction. Okay, the reaction of gold in 2025 was exceptionally absurd, but still. Let me show you why. The correlation between Bitcoin and gold has dropped to minus 0.17. They do not move together at all. But Bitcoin's correlation to the Nasdaq sits at roughly 0.8. That means Bitcoin trades like a leveraged tech stock, not like a safe haven. And the crisis behavior confirms it. During equity market drawdowns of more than 12%, since Bitcoin has existed, gold delivered on average a positive 4.7% return. Bitcoin, it got sold alongside everything else. In October 2025, $19 billion in Bitcoin positions were liquidated in a single day. This is not a safe haven behavior, this is a risk asset in a liquidity crisis. So, what is Bitcoin if it's not a digital gold? And this is where we need to address the elephant in the room. The most common objection: Bitcoin has no intrinsic value. You cannot touch it, it's just a number on a screen. Fair enough. But what is the money in your bank account? It's also just numbers, a database entry on a server. The difference is who controls the rules. With your fiat currency, your dollars or euros, you trust politicians and central bankers not to debase it. History shows they almost always do. We call that inflation. With Bitcoin, the supply is hard capped at 21 million units. Not by a promise, by mathematics, by code that anyone can inspect. Gold is scarce because of physics. You need energy to dig it out of the ground. Bitcoin is scarce because of cryptography. You need energy to mine valid blocks. Both cause real resource to produce. With gold, the rules are set by geology. With Bitcoin, by an open protocol no single person can change. That does not guarantee Bitcoin will be worth more tomorrow. But the argument that it has zero value because you cannot hold it, well, that applies to 90% of the money in the global financial system right now. So, if Bitcoin is not digital gold and it is not worthless, what is it? Think of it as a venture capital bet. A bet on the future relevance of decentralized, censorship-resistant store of value in a world of rising government debt. The numbers tell us both sides. Bitcoin's annualized volatility runs between 60 and 72%. Gold sits at 12 to 16%, 3 to 5 times more volatile. But zoom out. Over 10 years, Bitcoin returned over 16,000%. Gold returned 311%, and the S&P 500 returned 257%. The price of that return, drawdowns, that would make investors physically sick. The average maximum drawdown across Bitcoin cycles is minus 79%. The current correction sits at minus 52%. Average recovery time to a new all-time high, about 21 months. Institutions accept this as a feature of the asset class. Retail investors experience it as a nightmare. The difference is not courage, it is process. And here's the answer to the questions from the last episode. Bitcoin is a complement to gold, not a replacement. Gold is the insurance you hold when the system breaks. Bitcoin is the asymmetric bet you hold for what comes after. And because their correlation sits at minus 0.17, holding both actually gives you a genuine diversification. That was the hard data, no hype. Bitcoin is not digital gold. It is a fundamentally different animal. But here is where it gets practical. Because depending on where you invest, your regulatory environment either helps you or holds you back. And after that, the exact allocation framework that institutions use and how you can apply it. Stay with me. The regulatory landscape. For years, the biggest objection from compliance department was simple: no regulatory framework. We cannot invest in a legal gray zone. That has changed. In the EU, MiCA, the Markets and Crypto Asset Regulation, has been fully enforced since December 2024. First comprehensive crypto framework in the world. Authorization required. Custody standards defined. In the US, regulations remains fragmented. The current administration is pro-crypto and established a strategic Bitcoin reserve. But legal patchwork across the SEC, CFTC, and state laws is still being sorted out. One development most professionals missed: starting March 2026, the ECB will accept tokenized versions of traditional assets, like government bonds, as collateral in its credit operations. That does not mean Bitcoin is now central bank money. It means the old system is quietly moving onto a new rails, distributed ledger technology. Regulatory clarity is no longer a reason to stay on the sidelines. The question is now how to allocate. So, How much Bitcoin should you actually go into a portfolio? Let me show you what the largest institutions recommend. BlackRock, December 2024, suggested 1 to 2%. At that level, Bitcoin's risk contribution to a diversified portfolio is comparable to holding a single large tech stock. Go above 2% and Bitcoin starts to dominate your risk profile. At 4% allocation, Bitcoin contributes roughly 14% of your total portfolio risk. Fidelity goes slightly higher, to 2 to 5%. ARK Invest, led by Cathie Wood, sits at the aggressive end with allocation that have climbed to nearly 20% in their models. For context, ARK projects Bitcoin reaching over $1 million by 2030. Treat that as an outlier view. The academic consensus lands between 1 and 5%. At those levels, studies suggest Bitcoin can improve risk-adjusted returns, primarily through its low correlation to other asset classes over longer time periods. Now, how to access it? Option 1. Spot ETFs. Simplest route. Professional custody annual fees between 0.15 and 0.25%. The trade-off? You do not own the Bitcoin directly. And 9 out of 12 US spot ETFs use Coinbase as their custodian, a concentration risk worth knowing about. Option 2. Direct purchase through a regulated exchange. You hold your own keys. You eliminate counterparty risk, but lose those keys and lose everything. Critical detail. Depending on your country and product, the tax treatment between direct holding and an exchange-traded product can differ significantly. Check your local rules before you act. Regardless of how you access it, the institutional discipline applies. The same rebalancing logic I showed you with gold. If your 2% Bitcoin position runs to 5%, you trim. You take profit, you reallocate. The Wisconsin pension fund did exactly this. Realized gains on their direct ETF position, then maintained crypto exposure through equity proxies like Coinbase and MicroStrategy stock. That is not panic selling, that is process. So, let's wrap it up. Bitcoin has left its teenage years behind. It is regulated, institutionally accessible, integrated into portfolios across the globe. But it remains the most volatile mainstream asset in the world. 60 to 70% annualized volatility, drawdowns that regularly exceed 50%, a track record of 16 years versus gold's 5,000s. It is not insurance, it is not a safe haven, and it's not digital gold. At least, not yet. What it is the first digitally scarce asset in human history. Hard capped at 21 million units, with an inflation rate already lower than gold's, and an institutional adoption curve moving 5 times faster than gold ETFs did 20 years ago. The institutions are here, but they came with 1 to 2% allocations, not with 20. The smartest approach: treat Bitcoin as a complement to gold, not a substitute. Gold for crisis protection, Bitcoin for asymmetric upside, both together for genuine diversification. The rebellion that started in 2008 did not destroy the financial system, it became part of it. And that might be the most bullish case of all. Comment below, what is your take on Bitcoin? I'm Philip. If you want to keep getting institutional grade insights, the kind of analysis that goes beyond headlines and actually shows you how the smart money operates, then subscribe, hit the bell, and do not miss the next one. In the next episode, we close out the asset class series with the tools institutions use to manage all of this: derivatives, options, futures, and the hedging strategies behind billion-dollar portfolios. See you there.